let's move on to investment tip number 3. Diversification is your safety net. You've probably heard the old saying, don't put all your eggs in one basket. And when it comes to investing, that's some of the best advice you'll ever get. Diversification means spreading your money across different investments so that if one goes bad, it doesn't wipe you out. Think about it like this. If you put all your money into one stock and that company goes bankrupt, you lose everything. But if you spread your money across 10 stocks, one company failing only hurts you a little bit. The other 9 can still do well. Now, diversification isn't just about owning multiple stocks. It's about spreading your money across different types of assets. Stocks, bonds, real estate, commodities, maybe even some alternative investments like art or crypto if you understand them. The idea is that different assets perform well at different times. When stocks are down, bonds might be up. When real estate is struggling, commodities might be thriving. By diversifying, you smooth out the ups and downs and reduce your overall risk. One of the easiest ways to diversify is through index funds. These are funds that hold a little bit of everything. For example, an S&P 500 index fund holds shares in 500 of the biggest companies in America. So instead of trying to pick the next Amazon, you just own a piece of all of them. It's simple, low cost, and incredibly effective. In fact, Warren Buffett himself has said that for most people, index funds are the best investment. You don't need to be a stock-picking genius. You just need to own a diversified portfolio and let it grow over time. But here's the thing, diversification isn't about avoiding risk altogether. It's about managing it. You still need to take some risk if you want to grow your wealth. The key is making sure that one bad decision doesn't destroy everything you've built. So, investment tip number 3, diversify your portfolio. Spread your money across different assets. Use index funds if you're not sure where to start. And remember, diversification is your safety net. It won't make you rich overnight, but it'll protect you from catastrophic losses. All right, moving on to investment tip number 4, understand the difference between active and passive investing. Because this is where a lot of people waste time and money. Active investing is when you're constantly buying and selling, trying to beat the market. You're picking individual stocks, timing your trades, trying to outsmart everyone else. Passive investing, on the other hand, is when you buy a diversified portfolio and hold it for the long term. You're not trying to beat the market, you're just trying to match it. And here's the thing, study after study shows that passive investing beats active investing over the long term. Why? Because active investing comes with costs. Every time you trade, you pay fees. Every time you sell, you might owe taxes. And most importantly, trying to time the market is incredibly hard. Even professional fund managers, people who do this for a living, struggle to beat the market consistently. In fact, over a 15 or 20-year period, the vast majority of actively managed funds underperform a simple index fund. So why do people still try to actively trade? Because it's exciting. It feels like you're doing something. But the reality is, most of the time, doing nothing is the better strategy. Buy a diversified portfolio, hold it for decades, and let compounding do the work. That's how you build wealth. So investment tip number 4, understand the difference between active and passive investing. And unless you're a professional with a lot of time and expertise, passive investing is probably your best bet. All right, now let's talk about investment tip number 5, the power of dollar cost averaging. This is one of the simplest and most effective strategies for building wealth, and yet most people don't use it. Dollar cost averaging means investing a fixed amount of money at regular intervals, no matter what the market is doing. For example, let's say you invest $500 every month into an index fund. Some months the market is up and you buy fewer shares. Other months the market is down and you buy more shares. Over time, this averages out your cost and reduces the impact of market volatility. The beauty of dollar cost averaging is that it takes the guesswork out of investing. You don't have to worry about whether now is the right time to buy. You just invest consistently, month after month, year after year. This strategy also helps you avoid the emotional traps we talked about earlier. When the market crashes, you're not panicking and selling. You're buying more shares at a discount. When the market is soaring, you're not getting greedy and over-investing. You're just sticking to your plan, Dollar cost averaging is especially powerful when combined with time, because the longer you do it, the more you benefit from compounding. Even if you're only investing a small amount each month, over decades, it adds up to a substantial sum. So, investment tip number 5, use dollar cost averaging. Invest a fixed amount at regular intervals. Stick to your plan no matter what the market does, and let time and consistency do the heavy lifting. All right, let's move on to investment tip number 6. Avoid high fees like the plague. You see, fees might not seem like a big deal when you're starting out. A 1% management fee here, a small trading fee there. But over time, those fees can cost you hundreds of thousands of dollars. Let's say you invest $100,000 and it grows at 7% a year for 30 years. If you're paying a 1% fee, you'll end up with about $570,000. But if you're paying a 2% fee, you'll only end up with $430,000. That's a difference of $140,000. Just from fees. The financial industry loves fees because they're incredibly profitable. But for you, the investor, they're a silent wealth killer. That's why it's so important to pay attention to what you're being charged. Look for low-cost index funds. Avoid actively managed funds with high fees. And be wary of financial advisors who charge a percentage of your assets. Because the more you pay in fees, the less you keep. And over time, that difference compounds just like your returns do. So, investment tip number 6, avoid high fees, keep your costs low, and make sure that as much of your money as possible is working for you, not for someone else. All right, now let's talk about investment tip number 7, invest in what you understand. This might sound obvious, but it's one of the most violated principles in investing. People constantly put money into things they don't understand because someone told them it's a good idea. They buy tech stocks without knowing what the company does. They invest in crypto without understanding blockchain. They buy real estate in markets they've never visited. And then they're shocked when things don't work out. Warren Buffett has a rule. He only invests in businesses he understands. That's why he avoided tech stocks for years. Not because they were bad investments, but because he didn't feel like he understood them well enough. And you know what? He still became one of the richest people in the world. You don't need to invest in every hot new thing. You just need to invest in things you understand and believe in. If you don't understand how a company makes money, don't invest in it. If you don't understand how an asset generates returns, don't buy it. Stick to what you know. And if you want to expand into new areas, take the time to educate yourself first. Because when you invest in what you understand, you're not just hoping for the best. You're making informed decisions, and that's how you build lasting wealth. So, investment tip number 7, invest in what you understand. Don't chase trends you don't comprehend. Stick to your circle of competence, and if you want to expand it, learn first, invest second. All right, finally, let's talk about investment tip number 8. Think long-term and ignore the noise. You know, we live in a world that's obsessed with short-term results. The news is full of daily market updates. Social media is full of people bragging about their latest wins. And it's easy to get caught up in all of that. But here's the truth. The daily movements of the market don't matter. What matters is where your investments are in 10, 20, 30 years. The best investors in the world think in decades, not days. They ignore the noise. They don't panic when the market drops. They don't get greedy when it soars. They just stay focused on the long term. Think about it like this. If you were going to take a road trip across the country, would you turn around every time you hit a red light? Of course not. You'd keep driving because you know where you're going. The same applies to investing. There will be red lights. There will be detours. But if you stay focused on your destination, you'll get there. So, investment tip number 8. Think long-term. Ignore the daily noise, stay focused on your goals, and trust that time and compounding will do their job. All right, my friend, those were the 8 investment tips you cannot afford to ignore. If you take these lessons to heart and put them into action, you'll be well on your way to building the kind of wealth that lasts for generations. Remember, investing isn't about getting rich quick. It's about making smart decisions, staying disciplined, and letting time work in your favor. So start today, invest consistently, avoid the traps, and build the future you deserve. If you found value in this video, make sure to hit that like button and subscribe, because we've got a whole community of people just like you who are serious about building wealth and leveling up their lives. Until next time, take care, my friend.